Hello, everybody. Hope everybody's having a good day, and welcome back to another edition of Trend Following Trading Club. Oh, right. Okay, I was hesitating to get started until Oleg showed up. He just got in, so I think it's safe. We can go now. Um, we had a good week, and wanted to bring up a few topics that we could talk about if it interests anyone, and that would be last week's Twitter Spaces with Tom Basso and Rich and me and a few other people. That was pretty fun. Uh, I forgot to hit the record button, so that's a shame. And maybe we'll get him back one of these days. Um, Also, I don't know if anybody. Hopefully, everybody listened to Rich's podcast with Niels. That was superstar. Can't tell you how great that thing was. I took a lot of notes. I like to listen to those things 3 or 4 or 5 times, and I didn't get a chance, just like twice, I think, but it was very good. I learned a lot. Um, and Just going back over that some, I have a few questions for Professor Brennan. Um, so that was really good stuff. There's probably some other things going on Twitter this week that you probably want to bring up and chat about. But I'll open up the floor to other people. We can get going.
Good morning, all. I'll just need a couple of minutes, but I did want to share some back test results between the Tom Basso position sizing model and then the traditional trend following. So I'll just reconnect in about 2 or 3 minutes.
Hi, everybody. Great to be here. I suppose we'll wait till Boris gets back with his backtest results, but it certainly was quite active on the volatility targeting discussion this week. I must admit, I'm getting a bit drained with this entire discussion, but Jerry, how are you holding up?
I'm doing well. I mean, my biggest regret is just missed opportunities and not remembering, things I may have wanted to say, or, you know, um, honestly, my big takeaway. And I don't think we explicitly said this. So, usually, me, I like to double down, triple down. Uh, become more intense about something. And I think we have an opportunity because I don't know if you said, or maybe I'm overstating, of course, but the one of the things I don't think we explicitly stated, which I think is true, but I'll let you lead us in this area, and that is that there's just a lot of talk about taking risk off the table. Um, I don't really want to pay too much attention to outright. Uh, I'm nervous and I want to take some profits. That I don't think is anything we need to discuss. But certainly the reducing risk. But I think if I understand you correctly, I think it's a fair to say that if you don't risk manage, and then I think Michael brought up a couple of points on Twitter that we need to be careful. I need to be careful with the words I choose, but sort of volatility management and trade volatility management is different than volatility targeting, which I think is the whole portfolio. So there's trade by trade, there's volatility, there's portfolio, there's throw correlation in. And then Niels brought up a point I don't think it's much of a concern from our position, which is that with trade volatility management, you can actually get into a situation where you're increasing the position if volatility slows down a bit. So you're not taking smaller profits necessarily, which I don't think is much of an issue because it's pretty rare. In a big, huge monster outlier, you're going to get nothing but increased vol. But anyways, finally to my point, and that is that I think it's not an overstatement to say from our perspective that not managing the risk of the trade and not reducing the trade, the outlier position, the positions in an outlier reduces risk. We actually, I believe, think risk is increased by reducing risk. So if you go in and the ATR is 5 times as high as it was, and you take off something because the risk is increased, I think from our perspective, we think you're increasing risk.
Yeah, look, I personally think the distinguishing factor is that you and I, once we've committed a trade to an event, a trade entry, we don't touch the position size. So at the point of trade commitment, we know what our maximum risk exposure on our realized balance is, but then we're prepared to play with our unrealized or our floating equity on as the basis of this definition of letting profits run. So I know that previously I was focused very much on taking profits off the table, but Niels is right. You've also, in the strict definition of this volatility targeting, which Morris sort of, led me to, in that you can also increase your position sizes post-entry in relation to what volatility is doing. So if volatility is decreasing post-entry, your position size will increase, and as volatility is increasing, your position size will decrease to maintain this constant volatility target. That's what Morris's definition is. Happy to accept that. However, where I have my disagreement is that any tampering post-entry to me is an assumption that you have additional information that bears weight on the fly after you've entered a trade that holds additional information that you haven't picked up in your rules-based process, and you're prepared to make almost a discretionary decision to adjust your position size based on the volatility level. Now, I don't think outliers are like that. I believe they're totally unpredictable. So I'm not prepared to make any form of opinion post-entry. All I know is that I have risked a maximum risk per bet that I'm prepared to tolerate on realized balance. Everything else to me is unpredictable, so I just let it flow and let it run.
Hi to everyone. As always, I'm saying that I'm very happy to be here. On this point, I have an opinion that it's very important, a great idea, not to touch the position after we have this position in our trade activity, because I mentioned in my research, I mentioned that when we capture a very successful big trends, we have very successful trades. Very often, mostly, and maybe even yes, mostly, almost every time this position is in a very good way is doing, because before the trending period we can see, as usual, a big flattish period, and in flattish period our position size is lower, so we can capture the big trend and in a very good way, not touching this position. And if we and as Jerry is saying always, that consistency is very important, and this way of consistency is a great way of consistency, that we have done the position, we have done our trade, and we are just waiting. Don't do nothing, and I mean, do nothing, wait, and not don't do nothing, do nothing and wait. And I mentioned in my research maybe 5 or 6 or 7 years ago that it's the best way.
Hey guys, something that I took away from this Twitter space, really enjoyed it, was that to me it felt that it's not just about either vol targeting or not vol targeting, but the way that Tom looks his open equity drawdown differently than Jerry and Richard do. That Tom pays attention to the open equity drawdown, tries to limit it with vol targeting, and also he takes on new risk calculated from the total account value, while Jerry, and I assume Richard also, I'm not sure, but Jerry looks at closed equity to put on new risk, and therefore doesn't care that much about the open equity drawdowns and the volatility there. And actually, for this week, during the week now, have been thinking about it a lot for myself. That I actually kind of are in the both sides. That I don't want to vol target. I don't want to look at the open equity drawdowns and the open profit. Meanwhile, I am using my total account value to put on new risk. So it may sound like irresponsible risk taking that I use my open position, let's say Nvidia, which I've been holding for 2 years almost, and it's 4 times the position that I put on, and now the open profit is dictating my risk size on new positions. But yeah, another thing for me is that why I use open profit, open equity for new risk size calculation is that I wanna take maximum out of the compounding effect, and therefore I also use like different time frame strategies. Maybe that's the case that I want to do it that way. But another thing that started to make me consider a bit maybe closed equity calculation is that trading is my main source of income, and I need to withdraw money to cover living expenses, and I withdraw money from time to time, and so this using closed equity for new risk would maybe allow better to withdraw the profits, but I'm not still sure. I don't want to kill the compounding.
Yeah, thanks, Marcus. Yeah, I definitely think that the calculation of trade level is a very big part of all of this. You know, on one hand, as I've said many times, I'm very risky and crazy risky with these open profits. And then behind the scenes, my trade level is very conservative and, you know, low. It's kind of low. So I think Richard and I, we mentioned this before, we kind of don't do it the same way. We kind of don't agree 100% exactly on this trade level thing. The way I would never make my trade level greater than my closed trade equity, but I also feel, you know, I'm putting out my feelings here. I haven't done the research like I need to, and I don't know if it's the back test would be a fantastic guide, but I also have another concern, which is I want my trade level to be consistent, the same. I want it to be the same for like the year, like a whole year. So I won't just every day have a new trade level, but given that my closed trade equity might be changing every day, but I'll maybe use the closed trade equity on January the 1st, and then for all the new trades for the coming year, and then move it up maybe next year or at a later date. So I really want to have a lot of my trades on with the same trade equity. So I have two concerns, not just closed trade equity or not using the total assets, but also I want to make it sort of consistent. And so I have a lot of trades with the same exact bet. You know, I sized it based on ATR. I gave them all the same position based upon ATR, the same loss potential multiples of the ATR. So that's what I want to do. I want to go in, sit down at the blackjack table, and bet $1,000 on every hand for like a year or whatever. So that's another concern of mine. But I do think if you're using AUM, daily AUM, especially seeing what we've seen over the past couple of years with fantastic trend following profits, then I hate to be critical, but if you're doing that, that's a mistake, okay? And you've got to make up for it somewhere else. You feel this pressure. You know, okay, maybe I'll have to volatility adjust some positions, which that's wrong as well. So get rid of all the wrong stuff and just go back to closed trade equity. I'm smiling because I didn't really mean it was necessarily wrong. I'm trying to be more open-minded.
Yeah.
Look at the logic here. So let's assume we're holding an outlier for 2 years. If you are volatility adjusting or volatility targeting based on that outlier that you're holding for 2 years, how many interference points are you going to make in that trade? And what is the transactional cost of all of that interference you're going to be doing over the course of that 2-year period as volatility goes up, volatility goes down, wiggles around, you never get this clean outlier. They're incredibly volatile, ups, downs. There's so much adjustment to do. What is the cost of that? And, I believe a much more efficient method is once you commit to that outlier, don't tamper with it, because you're not going to incur any additional costs of tampering. And these outliers, they represent maybe 5% of my trade distribution. So what what can I, what information can I get from 5% of my trade sample? Nothing. There's nothing I can tell about an outlier which is definitive. I can't tell whether an increase in volatility is going to last. I can't tell if a decrease in volatility is going to last. These outliers are anomalies. And I can tell things about my 95% of trades that are adverse to that outlier. I can tell what my adverse risk is. I can tell where to put my stops so I cut my losses short. But I can't tell anything about my letting profits run statement based on this 5% sample size. And anyone who infers that they can get more additional information out of an outlier that's more prescriptive, I think is kidding themselves.
Yeah. Yeah, I just wanted to Richard, what you told right now sounds totally robust and systematic, and that's all good. What I wanted to reply to Jerry about this closed equity trade level. I mean, there is this thing that if you do it once a year systematically, every time you take the closed equity trade level, there might be time when a lot of the good trends end, and you increase your trade level suddenly, like in a big way. If you've just had like a stellar year with many trends and they have now been closed, you need to raise the trade level suddenly and sharply. If you do it systematically, I don't know, maybe there should be some discretion in it that you do it slowly, or but I see if I don't do the AUM calculation daily, I do it weekly. And from one perspective, I see that if I do it weekly, no matter what my portfolio is doing at the moment, it's kind of systematic. It's slowly increasing or decreasing. I mean, adjusting the trade level. But if I do it once a year on closed equity, it may be like sharply one way or the other.
Good point. Yeah, I forgot about. I agree with that. I don't want to increase it very much each time either. So I want to be very conservative on that and uh, not do it often and not make each jump very large. And it gets really problematic when you make too much money. So this is one of those situations where we have all these dilemmas because we've had a really good period. So I'm kind of under trading now because but I think this whole idea of taking small profits and treating trades differently. If it's a profit, I'm going to let it run. If it's a loss, I'm going to get out. It just begs that, yes, it does seem logical to split those equities up as well. You've got the whole group of trades, which is open trade equity, that you're letting run. You've got all the other trades that are going to turn into losses and then have already turned into losses, which are closed trade equity. And so I look at it, as I've said before, as whether it's 70, 80, or 90% of my total equity, that's my line in the sand. I'm going to defend that. This stuff that they were talking about how they protect their profits and protect their risk last on the Twitter Spaces, it was way worse or more aggressive than I thought it would be. I mean, it's almost like they have as you make a dollar, you have to move the stop up a dollar, and let's classify that as risk, and let's just classify it as almost like personal preference, not subject to the back test. not subject to doing things in a better way. It's my personal preference. And then let's make the claim that it doesn't matter, for God's sakes. So much of that was going on. It was really frustrating to, I didn't think that a proper debate was going to be very possible, and I was right. But I still don't have Richard's buy-in on my controversial statement. And so I'll go a little bit further, which
Go
is,
for it, Jerry. Hit me.
yeah, I'm going to be nice. But, you know, the reason I think it's more risky to reduce those positions based upon volatility is because if you don't maximize the outliers, soon enough you will have that lack of profit in your account, and you will at a later date start having drawdowns and less and not having enough equity, not having the equity that you could have had if you would have let those profits run, because it feels so good to get rid of a quarter, a third, or a half of a position that is where the ATR has increased a lot. But in
No, I
six,
agree with you there. This is what I call the opportunity cost. So this is the cost of volatility targeting that people are refusing to admit. And you know, I totally agree with you, Jerry. There will be so outliers. Outliers to us are things that we refer to in almost infinite terms. We don't know how big they're going to be. So no matter what the backtest produces, that's a historical backtest, is always going to understate the outlier because it's based on history. But what happens if in the future there are more outliers that are bigger than what we've had against our history? That's where the volatility targeting comes undone, because that's where there is this tacit assumption in all of these methods that assumes that these trends are going to end. So they mean revert. So, you know, all of these people that, you know, we talk about ourselves being price followers, but by about volatility in the trades we take to adjust or make adjustments on the fly is a predictive mindset working, which we want to avoid because our whole basis is we can't make any assessments about these outliers because they could be huge. These king hits, these windfall events, these game changers, that's what we're targeting. And you can't, you know, model them.
I would say
Hi all.
when you do the vol targeting, right? Um, one good point that Richard brought up is the mean reverting effect of that. And obviously, when we're thinking about mean reverting, we're thinking about a linear scope, but we want to maximize the asymmetry. So the opposite. Well, not linear and asymmetry is not the opposite, but we want to maximize the asymmetry in that outlier. So basically, you're reducing the asymmetry in the trade by mean reverting, so you're making it more linear. And therefore, I agree with Jerry's statement, where basically um, you're reducing the opportunity cost, or you're making that outlier that you need to pay for all the costs that you're making. You're reducing that, and therefore, that has the negative
That's right.
impact.
That's this smoothness. You are reducing a positive skew to achieve smoothness. And that's, Jerry, and my argument, in that what we're doing here is we're turning these into nice, smooth equity curves, which we hold no truck with.
Hi all. Just reconnected, so apologies if I missed a part of the conversation. But as mentioned, I just like to bring up some of the back testing work that I've done. Now, I think it's worth mentioning that I'm not a computer programmer. I don't really have that kind of a background, but I did manage to put together something and then reach out to an incredibly intelligent guy, Marston Parker, who was featured in Schwager's last book, and he actually has an incredible software there called Real Test, which will allow you to do all of this stuff in really 20 lines of code versus hundreds in Python. So just worth checking out, and an incredibly generous guy with his time. So I reached out to him, and he's not a trend follower, so he doesn't really sit in any of the camps. But what we try to do is based on the podcast there with Rich, yourself, and Niels there, when you guys were where Niels, I think, made a very valid point in saying that if one is better than the other, then we should be able to test this and get the results. Now, there's a few things that need to be mentioned here as well. So the back test that we tested was between Tom Basso's system of vol targeting, position sizing versus just the classic trend following, meaning that you let your profits run. I'm sure that Rob Carver or some other guys, they probably vol target in a different way. So we just tested the Tom Basso one. It was tested over the Norgate data futures and from the 1980s, I believe, to 2022. The data in the 80s, obviously there's some symbols that are not available, so it was a bit difficult, but it still produced the equity graph that we needed to kind of compare the two systems. Now, here's some interesting things that I noted. So across the board, yes, it is more profitable to be a classic trend follower. That's what the data shows. It comes at the expense of steeper drawdowns. But the interesting thing is that the profitability is not as big, or the difference in profitability between two systems is not as big as I would have expected. Philosophically, I'm all in with you guys in terms of hunting for the outliers. But there's a few things as well that we just don't see in the data, at least the one that we ran using Tom Basso's system versus the classic trend following. I don't see evidence of regimes in terms of that, let's say in the 90s, it was a lot better to be classically trend following than it was to be taking, some positions off. In fact, during, I think from 2015, I don't have it in front of me right now, but onwards, the classical trend following does outperform, dynamically sizing your positions as per Tom Basso. So I didn't see really the regime, which I thought I probably would. That's number one. Number two, like I mentioned, the gap in profitability wasn't as large as I initially would have thought. Now, yes, we can obviously say, that the back test, we're not going to rely on it. I get the point about, potentially there being more outliers in the future than there were in the past. But, we could also say that there might be a potential where there are less outliers. So I don't know. The only thing that I can go based on empirically is the data that we have and the back test that we ran. The other thing worth mentioning as well is, and this was actually a point by Marston, which I never thought about, because initially when I tested it over ETFs, I saw the Tom Basso system being more profitable with less drawdowns, which didn't make sense to me, because I thought for sure that it'd be less profitable. But it could just very well be, and I don't know, I haven't thought this through, but posing it to the group here, it could just be that the net profit, right, of the pullbacks. So when you're taking positions off, the pullbacks exceeds or is greater than the profit that you would have gained from catching the outliers. Maybe because the frequency of the outliers is low. I don't know. But it's something interesting that I thought about. But I just wanted to kind of share those results and just kind of go over those comments.
Many thanks, Boris. Lots of food for thought there. Great stuff.
I want to say not only that I had experience with this vol targeting, and I have said this before in 2016, and I did a lot of things, a lot of research myself, because before I have discovered Top Traders on Blog, before I have discovered Jerry, Niels, and Maritz, and other guys whom I really trust very much now, I did not know whom I can trust, because I have seen different information, different sources of information in different directions, and I preferred to do research by myself. So I didn't even know this phrase, volatility targeting, but I had invented that vehicle. I had found this way of trading, and I thought that firstly, I thought it's a good way. And I had a good results, even maybe for 10 months with this in 2016. But I understood that it's all these volatility games it makes you less robust. First of all, less robust, more room for discretion, and it's more risky. And there's a very big question: can I trust all this data that I have? If we are speaking about classic trend following, I understand mostly how it works, how on what it is based on market structure. I understand this, and follow the price. It's the most perfect way that I can imagine. Most perfect. Follow the price. Simple. Follow the price. Capture the trends. Outliers capture the trend. But when we do these slow targeting models, we have something more complex, and so we do our strategy more complex, less robust, and we don't know what the future will bring here, what will regime, like Boris said, yes, and a lot of guys also said this, we don't know. Niels often says this, that we, and Jerry, that we don't know what the future will bring us. And we know that in almost all the circumstances, all the regimes, all these environments, trend following trading strategies done well. And this will targeting models, I'm not sure that it will be so perfect as trend following, classical trend following. Even if we have a very good backtest, even if we have this, I don't think that it's necessary will be in the future with the same probability like we can talk about classical trend following.
Yeah,
Yeah,
just sorry, just wanted to make one point there. Look, I completely agree. I don't give too much significance in the back test, but I think we have to be genuine here and careful that we can't in one breath say that the back test is absolutely useless, but in another rely on it for our breakout models, for testing our ATRs and all of that kind of stuff. I think there is some validity in the data that we have up until this point. We have to go on something, right? Now, I completely agree with Niels in terms of that, him saying, look, there has to be something that's empirically better. And I'm not talking about the future, I'm talking about what has happened right until now. So why is it that we can't test these two things? And why is it that a lot of folks are saying, hey, look, we got all these back tests and it proves this and it proves that, but they're not very consistent. So I'd encourage everybody, and there could be a very high chance that in the back test that I performed, or the Marston kind of put together, that there could be something that is wrong. Logically, that's wrong. Maybe we're not paying attention to something. I don't know. But I'd encourage everybody in this group to back test it, because I think it's a worthy exercise. Philosophically, like I said, there's a lot of points that I wouldn't have expected to see in the data. And when I ran the data, I had to kind of readjust some of those philosophical leanings. Now, I still think, and this is the key point that I found, that the way to go for myself, at least, is classical trend following because of simplicity, right? There's something to be said about volatility adjusting, or cutting your position sizes and staying on top of all these markets. There's just far too much complexity, personally, in Tom Bassel's system for me to be investing that time and energy, and at the end of the day it's not as profitable, slightly less profitable, but it's just the complexity is not worth it. And something within the complexity of execution might cause me to make a mistake. And it's that mistake that might just compound into something else and then completely derail the system. So I'm kind of hesitant to do something that's complicated in execution, number one. And number two, I really don't see how Tom Bassel's system could work on investors or traders that have less capital, right? Or that don't have big accounts. Because, I mean, for some of them, you can't put on that size. If you're going to be peeling off position after position and, whatever, over across 20, 30 markets, you need to have a genuinely big account to do this, right? I mean, if you can only just afford one or two contracts, that's very hard for you to do the vol targeting. So that's another kind of obstacle that I found that doesn't make it worth my while currently. But yeah, don't want to ramble too long.
You make some great points there, Marcus, and really, I think you're answering your question, because you've said in your testing, you've concluded that there is not much material difference between the two methods. You say that what we do find is we have lower drawdowns with one versus the other, but we actually find there might be a slight improvement in the KGAR when we don't tamper with it. That's enough for me. That's enough for me. When we're dealing with a very small, weak edge.
Yeah, I guess. Look, I guess it depends on what your situation is. I get Tom's point about managing money, right? With the lower drawdowns would probably help, especially at the expense of not that lower of profitability. Maybe even for your own personal retirement account. I don't know. Everybody I guess has different lifestyle considerations. But yeah, there's those two kinks: the complexity issue, the fact that you have to be trading at least over $1 million, to me to be able to execute some of these vol targeting positions, that to me is a bit difficult, and it's really a tough sell to most retail traders, I would think, even though in theory it might sound great, but I just came across those two hurdles.
Yeah, so yeah, I think you're right. I mean, one of the things you brought up is a good point about sometimes it sounds like, especially coming from me, that okay, I'm not going to pay attention to this back test, and then the next minute I'll say, oh, I did this back test, and I'm going to go with this back test. So, but I do think that the answer to your point is that some of these back tests we should not pay attention to, and that's because of the sample size. And I think that these type of profit taking, I think they have an issue with sample size that we don't have with breakout entry, breakout exit, and an ATR stop loss. That adding more, I wouldn't call it that much complexity. I'm not going to give them any credit acting like this is really complex, but it is more stuff going on. And I personally think that my next step is to understand how sample size is impacted by these volatility targeting and volatility adjusting. And then number two is, and this was pretty evident when we had the Twitter Spaces, that you need to change your methodology from Kager or Serenity to something more Sharpie in order to justify this type of adjustment trading and position adjusting. I wanted to get over to Jason. There's some questions in the chat room chat, which I'll get to, Andre, in just a second. But Jason asked a question along these lines, and he goes, do we have a balanced portfolio if we do not volatility target? And so I think that's an interesting question, and I think that the answer is no. I mean, we don't, if we're sizing our positions to try to, based on the ATR, all I'm doing with that is normalizing my losses. So the minute that trade takes off after day one, after the entry, the ATR is moving around. It's getting a lot bigger, a lot smaller. It's not changing very much. Anything and everything is happening. And so I've got some diversification. I've got some currencies, commodities, stocks, and bonds. I've got some shorts and longs, but I'm not targeting this balance. I'm targeting the outliers, and I'm just going to sell out for the outliers and be thankful for having more diversification maybe than stock traders, but I'm not going to obsess over this balancing. And I think the uh, volatility management people, they do want more of a balance, and they do not want to have these drawdowns, and they want to take those profits, but that's not the game that I'm going to play. Now I want to move on to one more thing, and because I probably am going to have to go at the top of the hour, but oh yeah, another thing that Rich brought up not recently, I don't think, but he's brought up before. And I thought, it takes me a few weeks, and then I finally understand it, or maybe I've misinterpreted it. But, one of the things that okay, so my question is, what is the purpose of risk, of Sharpe, of MAR, of Serenity Ratio? What is our purpose for these things? Like when allocators and investors try to look at our historical performance, or we're looking at backtest of of a choice between parameters and systems we're going to trade, and we're using these popular methods to compare the reward to the risk. What exactly is the ultimate purpose behind all of this? Now,
I'll tell you.
let me
Sharp.
finish, because let me
Okay,
finish,
go for
and
it, Jerry. Yep.
then I think, because I want to make sure you answer, uh, and I think because it's what you told us, and you brought it up, and you brought it up many times, and I had never heard this before, and then because at one point you've said things like, this long-term track record is the evidence. Aha, that's right. And that's what we're trying to accomplish with these ratios. Who is going to survive? Because if you survive with a better CAGR and with this volatility over 20, 30, 50 years, that's where we should have put our money, because he survived. She survived. And this is what they're an approximation of, are you going to survive? And the fact of the matter is, taking these small losses and focusing on closed trade level and letting the open trade uh, risk volatility do what it's going to do, those drawdowns on mega trades are not impacting your ability to survive, especially if you're using trade level the way Rich and I are encouraging people to not use total AUM as the trade level. So I don't think the volatility of open trade equity has anything to do with survival. Go, Rich.
That's where the light bulbs flicker, Jerry, because there is no better risk metric than a survival record. So a validated track record is the best of any risk metric. The reason people use Sharpe is because they don't have a validated track record, and they've got to use a proxy for risk. And their proxy for risk is based on the history that the fund has been operating. And it might only be 5 years. And if that produces a high Sharpe, that that leads to this concept of expected returns. They expect to produce that in the future. Now, the argument is that over a very long-term track record, you're faced with multiple different regimes. And so if you adopt a Sharpe metric, which is looking at the smoothest possible return, which is a curve fit return for a particular 5-year regime, you will considerably understate your risk. The validated track record of 30 years, 40 years picks that up. What we want to do is we want to look at what is the risk over an array of different regimes. And therefore, we've got to look at risk in terms of the geometry. What is the maximum adverse excursions of that portfolio record? And what is the maximum optimal uplifts of that record? It's the adverse points of that equity curve. And that's why, in the absence of a validated track record, our second preferable metric is something like Serenity or MAR, because it's looking at the relationship between risk and reward over multiple regimes by looking at the CAGR divided by the max draw. It's not looking at this concept of expected returns, which nobody knows what's going to happen in the future. And the expected returns is something that has infiltrated economic orthodoxy with not only Sharpe, modern portfolio theory, all of these things have been sort of toxically affected by this viewpoint that volatility is risk. We know that's not the case. We have these volatile equity curves, but over a very long period. People with sharp high up, they might survive for 3 or 5 years, but they're going to have a blow up where they suddenly, they're no longer a survivor in that track record. They're actually gone from the record. But they didn't see that risk in that sharp. That risk caught that uncertainty, which wasn't reflected in their record, is the thing that ultimately was their demise. Long-term capital management, these things. So track record survivorship is the best form of risk metric.
But just a question though, can we really go based on track record of a few funds? I mean, look, for every Jerry, there's, I believe, probably hundreds of non-Jerrys, right? So if we're taking the 20, CTAs that have survived since the 70s or 80s or 90s or whatever the case may be, are we not discounting the hundreds of CTAs that have failed, potentially doing trend following the way it was meant to be done? Now, I don't know, there could be some operational issues there, lack of sale, whatever the case may be, but is it really fair to base track records? I mean, what I'm getting at, I guess, here is survivorship bias at the CTA level, not just the trade level.
I think at the same way you mentioned, in terms of not discounting data, because that's what we can go off to. I mean, in that same way, these survivors almost is also data that we can use to validate things, right?
That
Or am I
No,
wrong?
because I mean, look, there is the data, right? We can pull the data of the CTAs that went out of business, and we can find out why they went out of business, right? Now, whether it was operational in nature, administrative in nature, I don't know, but there is that data, right? It wouldn't be, it, yeah, there is that data, right? We can pull that, so that's just what I mean when we report these CTAs, right? And rightfully so, because they've done great. We're also not reporting the ones that have not done great, that have gone out of business, right? And we're focusing on the outliers, right, in many ways. But I guess to get a clearer picture, and why it's also kind of tricky to just rely on track records, is because maybe there's a bunch of CTAs out there that did all the right things, that did trend following the way that it was meant to be done, and they just didn't work out. And I'd be curious to see why. Maybe another research project I'll involve myself with, but
I want to say that I think, and I'm sure, for me personally, Sharp and something similar to that is a more commercial tool, marketing tool for attracting. For attracting money, maybe to a fund, or attention to a personality. It's like predictions. My father, a few days ago, my father asked me, what will be with Russian ruble, Russian economy? And I said, I have no idea. I don't know what will be with the Russian economy, with the Russian ruble. Even if I have maybe some thoughts on this topic, but it's not professional thoughts. It's only my human personality thoughts, and there is nothing professional in it. I think so. I have no idea. And he said, but experts says that ruble will be failing. 90% of experts said this, and I said, this expert, these people want only attention to themselves, to their funds or their personalities. If they're maybe journalists or something like that, they want only this. And this Sharp, yes, people like smooth returns. Yes, people like this, and it's very good tool for attracting attention. But this tool is miserable if we are comparing to a long-term good track record. And if we are talking about some tool or something like this, we must think what is this nature of this, what the nature of Sharp. And people don't think about the nature of things. They think about, oh, I can see smooth returns and it's safe, it's okay, I will give all my money I have to this fund. But it's a wrong decision. Before forming an opinion on a topic, we must understand the nature of a topic, of a nature of the thing we do. And sharp has nothing to do with effectiveness if we look at the nature of sharp.
So another thing I wanted to mention is, oh yeah, so go. Can't recommend more highly. Rich's podcast with Niels, and I saw this new feature on YouTube where you can make a clip of 1 minute, a 1 minute clip of a YouTube. So on some of those, towards the end of the podcast, when Rich and Niels were talking about geometry and trade drawdowns, and then step ups, I just could not do those things justice. So I clipped off a couple of minutes of Rich talking. So those things are outstanding. I mean, he just does such a great job. And but then this conversation reminds me a bit of this other guy. I highly recommend you Google. I've tweeted Mark Spitznagel as often as I can. He's uh, the guy that made thousands of percent 1 year when the stocks sold off with Taleb and their fund. But one of the things he said recently was that Sharp seems to be more correlated with going bankrupt than it does with risk. So yeah, so I think all of that stuff is great. And then, yeah, the whole geometry thing with Niels, Rich, you kind of crushed it on that. And it was this situation where you explained, Niels had a question, which kind of like these questions and these challenges to classic, they always sound so good. I think now I'm going to stump Rich, but it never works, because you're right. And so Niels made the point that, hey, okay, so let's forget this idea of trade level and the proper trade levels and the improper trade level calculations. But he says, okay, when you have these drawdowns on a trade or a group of trades, let's say, it's going to impact your compounding because the trade level is coming down. So you want to keep that trade level high and not have these big drawdowns. And then your response was, it's the geometry is that the outliers overwhelm these drawdowns, and they are more influential in creating this compounding versus the negative of the drawdown piece. And I thought, yes, brilliant. And that is so good. I mean, everybody, you got to go back and listen to this multiple times. It's so good.
Cheers,
I
Jerry.
guess there's
Look,
one.
just one really quick thing. I spoke with Linus, who prepares that Nielsen Hedge database, and I've asked him the question about the survivorship bias in the CTA track record. Now, I know Jacob Schott in Twitter says that there's a legacy of many CTAs that have gone underwater over the history. Now, I haven't found evidence of that. I find it almost very difficult to find trend followers, classic trend followers, that have actually gone to risk of ruin. I find lots of evidence of different forms of hedge fund that do go to risk of ruin, but I don't find trend followers do. I find that their absence from the record is usually due to their life cycle expiring. They might have 20, 30 years, 25 years. That program is over. They retire. A good example is Bill Dryce. He retired with this marvellous track record, and now he's gone from the record. And so people will say, well, those that are gone from the record, they can be just as, very successful. It's just that, they've made a business decision that it's time to wind up the program. And you'll find that most classic trend followers, or most trend followers, actually don't go the way of the dodo by virtue of poor performance. There will be periods of time where they don't catch outliers all the time, but it's, and there will be times where they produce sort of average performance or even slight underperformance, but they're not going to wipe out your capital.
And the biggest reason that people have major problems, whether it's bad performance, bad relative performance, or going out of business and going away, is just over trading, number one. And then number two, it's not being consistent with your system or overfitting the system. So I think it's perfectly fine. I mean, I can't think of anything that's more reliable than a one entry, one exit, and one stop loss system, without too many rules. So I think that's kind of reliable. And I think looking back over the past 30, 40 years of data, the most important thing is, will you see that these drawdowns of open trades does can and has had an impact on your survivability? And I just don't think that's true. It's not going to be true. So I think it's very difficult to get a lot of information from um, actual track records, in the sense that we don't know what people are really doing. And you could do your own back test and it would be fairly evident of how to go forward in what I would consider to be the most prudent, and I would just choose the most conservative way.
Fully,
Honestly, I want to be an
fully,
unlikely cheerleader for Sharp and all this vol management. Well, that I'm a bit more of an enthusiastic cheerleader for, but I really don't like Sharp. But the good intuition about Sharp is that you're using a statistic, a second moment, volatility of variance, to harmonize all these different strategies. And then obviously it's a denominator, and then you can compare everything. So that's number one. Number two, it is very true. It's been proved. There are plenty of mathematical proofs that if you can narrow down the denominator, your chances of success and survivability, and so track record and all the good things that Richard was mentioning, are going to be higher. What is the problem? I do agree with Richard though that high Sharp invariably seems to translate into disaster. So what Mark Spitznagel was saying, it correlates positively with risk of ruin, is because people swap second moment, i.e. volatility and variance, for third and fourth, for skew, i.e. symmetry, and kurtosis. And that's obviously a recipe for disaster. So I think we should be putting in focus a little bit the kind of honest, for lack of better words, use of Sharp versus less honest. And then the other point I wanted to make is, Boris, your backtest is very interesting. The one thing that I'm going to point a bit out to all of you guys is that I think there's a big difference between volatility targeting as you conceive it and volatility targeting which is done in relation with signal strength. Because if you marry, and which is obviously my experience and my belief, but if you marry the strength and the precision of your signals with the capital allocation, not only you get a more uniform portfolio, going back to the question to Jerry before, but you're also getting I think you are increasing your chances for survival. That's the reason why I do it, not to curve fit or create artificial smoothness in the data, but to compensate for some of the known pitfalls of Sharp and all these risk metrics.
Hey, hi everyone. I am a bit late here. The day's been a rush. It's inflation day here in Brazil, so everything is off. But I think Bruno just hit the heart of the question. All this volatility targeting discussion goes hand in hand with a notion of approaching markets with this signal generation methodology or approach. So I was holding myself to ask Jerry and Rich. I think it all comes down with a simple question: why do you think trend following works? Because if you can answer this question, then we can go over signal generation, and I believe your answer to this will be that signal generation is not exactly needed for trend following to work, and therefore volatility targeting goes to the second, third, fourth consideration.
I think just to round it up for myself, I think for me personally to understand it is the geometry. So the asymmetry versus the linearity, and why that's the reason why looking at divergence is so profitable, or not profitable is not the right way, but is the way to go. So if if you maybe that's also a thing for someone else to just compare these methods and see what is it leading to, what kind of geometry is it leading to, is it asymmetry or linearity, and then you can see, you can compare those and what those effects are. That's how I view it.
I view trend following as basically being the beneficiary of market complexity. In other words, I'm focused only at the tails of the distribution of market returns, and I'm saying there is some behavior there that is not representative in the rest of the market distribution of returns where most traders participate. There is some different dynamics occurring there, such as positive feedback loops, things that are associated with tail behavior, things that can't be described by linear statistical models, things that require complex modeling, agent-based modeling to work out but never be able to define exactly. So there's this inherent uncertainty there. And because you're dealing with this inherent uncertainty, because trend following works, you've got to just let the market decide your wins and losses. Therefore, you need a system that is designed to capture that uncertainty and mitigate risk at all periods of time.
That's it. If you're worried about tail behavior, not worried. If you're focusing on tail behavior, on that region of the distribution that we know we don't know anything about it. We don't have any sample size to try to estimate what's the volatility level at that region. We don't even know if there is a second moment there. Why in hell would we worry ourselves with estimating volatility, with reducing our position at that region where we are suited to benefit the most? I
love you, Bruno. I love you, Bruno. You're right on my wave.
But it could
Yeah,
also be because, sorry, cut you off, but it could also be because the net profit of these pullbacks that get you out of positions exceeds the net profit of the outliers, right? Because we keep talking about these outliers, and it's great. That is what we're targeting, right? I don't think that the vol targeting crew, if you want to call it that, I don't think they want to. I know they are, but I don't think they're essentially cutting the outliers through some predictive methods. They're just measuring risk in a very different way than, let's say, we are. But
the
I
thing
think
is,
that sorry, go ahead.
the thing is, you. Okay. First of all, I can't think of a system much different than a breakout system. So I am starting from the point that we are twitching a breakout system. Okay. So if you're going to volatility target, you must do it all the time. You cannot at some point you start volatility targeting. So that's another assumption I'm making here. So if you're volatility targeting all the way along the trade, you're not exploiting that outlier move all the way up. Yes, you're right. You will diminish what's the give back you're encountering, because at some point when your trade profit, when your open trade equity is at the maximum, at that time you will probably be on a small position. But on all the way up there, you will be reducing your position. So the way up will be less volatile. That's it. It will be smaller than all the way up with a classic trend following breakout system. So I'm not
Right.
convinced that this give back reduction will pay out. To be honest, I'm cooking something with my backtest algorithms here. I was hoping to get it ready today, but sadly I couldn't. So hang on, guys. The weekend will be wild.
So I see what you're saying, right? But empirically in the data that we see, we don't see, at least I haven't seen, I can't speak on any other back tests. I haven't seen many, but I can say with 100% certainty that like I would expect to see the difference quite drastic. I don't see that, right? I don't see that. So I get why it's okay for us to be dismissive of vol targeting, right? I get it. But I think we also have to be just careful not to be overly dogmatic and just to kind of think, what other people prioritize, right? If you're prioritizing things like Sharpe ratio, which I don't agree with, right? 100%, right? Classical trend following is not your thing, probably, whether right or wrong. But to your point, though, if you just run the back test and you look at the data, right, you don't see those huge differences that you would expect of you catching that outlier versus you cutting some of those positions. Now, once again, I got to repeat this because it's very important the way when we test these things, I try to be as bias free as I possibly can. I don't think it's 100% possible, but so I definitely welcome any back test, anybody from this group. It'll be a great experiment, but you know I guess we got to be careful in just saying that theoretically, this is what we would expect to see. If what we're running on the data from the 80s up until this point, which is what we currently have, is not saying that 100% convincingly. I don't see that huge jump, right? I do see a jump, but it's not that huge of a jump as I think some folks would like to think it is, which was surprising to me. So Bruno, if you want to, pass the results of that back test that you've done, absolutely. And anybody else, I'd love to see it. I really would.
I think
Yeah, no, you're right. You're absolutely right. We must have some empirical basis before getting to any conclusion. What I'm saying is, uh, from the way I understand that trend following systems work, that's my hypothesis. Let's put it this way. So I'm running this back test exactly to validate or not to confront, better to say, to confront this hypothesis, and let's see what comes out. What I'm saying is, what I expect to see is not a convincing result, because we're capping our average win while doing nothing to our average loss, while doing nothing to our hit rate. How come a system can be better if all these statistics are for the worse?
yeah,
Regard
my back test on this was, as I said in the Twitter Spaces, was that the risk of the open trade fluctuation gets transferred to your losing trades, and so you have to trade larger. So you're trading a system with 40% winning trades, bad enough. Now your average loss is a bit larger. Your risk of ruin is directly related to your closed trade equity, because your profits, it's obvious, your profits are smaller. And the profits are smaller uh, because you took smaller profits. And so you've got to trade bigger to make the same amount of money as not vol targeting. And it gets worse. You're looking at Sharpe, because Sharpe will tell you it'll probably be a big difference. Vol targeting is probably a lot better. Volatility management, adjusting the trades, whatever. It's probably going to be a big difference if you use Sharpe, because you're taking away some of that volatility. So what do you do when you have a higher Sharpe ratio? You trade larger. You say, oh, I don't care that I'm taking bigger losses now. I'm no longer risking 20 basis points. Maybe I'm risking 25. That's sounds kind of small. But whenever I come up with a good research idea and my Sharpe improves, this sends me another signal that I can trade larger. I need to trade larger by volatility adjusting, but now I want to trade larger. My system is better, it's more efficient, and you just can't get away. I'm the only one who wants to mention this, but look, it's a big deal. It's less robust. I don't know how you count the sample size when a large, maybe the majority of your trades have now gone from one entry, one exit stop loss, the core system. Now it's transferred over into the money management system. My gracious. So this needs to be counted. It needs to be taken into consideration. Okay, with that said, I'm going to have the last word and wish everybody a nice weekend, and we'll pick it up next week. Sorry I have to get off quick earlier. I have responsibilities, and but it's been fun. Take care, everybody.
Thank you, everyone.
Thanks,
Thanks,
Jerry.
everyone.
Thanks, everyone.
Bye.
Thanks, everybody.